Are dividends truly the holy grail of passive income? For many, the idea of regular payouts funding their lifestyle seems like the ultimate dream. But what if I told you that dividend investing might be quietly holding you down from building real wealth? Today we'll uncover the hidden flaws behind dividend investing and explore when a dividend payout for a company is a good idea and when it is a bad one. Dividend investing is a strategy built on simplicity. Buy stocks that pay out regular dividends, sit back, and collect the income. For many, it feels like a straightforward way to get rich. The appeal lies in its perceived stability. Companies that pay dividends often appear more mature and reliable. Investors see those regular payouts as a sign of security, especially when comparing to the volatility of growth stocks. Speaking of perceived stability, you know what else brings steady returns? Supporting this channel with the subscribe and like buttons. It helps to keep the content coming and makes sure you'll not miss out on the next video. But let's get back to dividends. Many dividend investors choose to reinvest their dividends. This allows them to buy more shares with the dividend payouts, which can theoretically lead to compounding. Over time, as more shares are getting purchased and additional dividends are paid out on those shares, the total dividend income increases, creating a potential snowball effect. However, while reinvesting dividends may boost returns, it's not always the optimal strategy compared to other wealth-building approaches. Dividends are usually seen as a reward for investors, but it's essential to understand why the companies pay them in the first place. Dividends typically signal that the company has matured and no longer has high growth opportunities. Instead of reinvesting their profits into new ventures, these companies return their capital to their shareholders. For dividends to make sense, the company has to make sure that it can afford to pay the dividend without jeopardizing its financial stability. Because sometimes companies choose to pay out dividends just to attract or maintain their investors, even though they cannot afford it. Issuing dividends irresponsibly can strain resources, limit long-term growth potential, and lead to unsustainable practices. While dividends can provide a consistent income, they're not always the best use of a company's cash. This is where share buybacks might be a good alternative for the company. If a company is undervalued, repurchasing shares might be a better use for their free cash flow. By buying back shares, the company reduces the amount of shares outstanding, effectively increasing the value of each remaining share. Let's consider a company with a market cap of $10 million trading at $10 per share with 1 million shares outstanding. The company generates $1 million in free cash flow and faces a decision: either pay a dividend or repurchase shares. Let's say they decide to pay out a dividend. The company would distribute the entire $1 million in free cash flow as a dividend, and each shareholder would receive $1 per share. If the company chooses to repurchase shares, at $10 per share, the company would be able to repurchase 100,000 shares, reducing the total number of shares outstanding to 900,000. Which means if the company issues a dividend from the same $1 million next year, the dividend per share increases to $1.11 compared to the dollar without the buyback. In other words, if a company only decides to pay dividends, shareholders will only receive $1 per share each year. However, if a company decides to buy back shares, your return from dividends would increase every year. You might argue that reinvesting the same dollar into the stock would lead to the same return, and on the surface that logic sounds correct. However, taxes significantly impact this outcome, which brings us to the next chapter. Taxes are often a nail in a coffin when it comes to dividend investing. When you receive dividends, you owe income tax on the entire amount, often at your highest tax rate. Compare this to growth stocks. With growth stocks, your wealth grows as the share price increases, and you pay taxes only when you sell the stock. Let's revisit the earlier example. Imagine you receive $1 per share. Depending on your tax bracket, a 30% tax rate would leave you with only 70 cents to reinvest. If you choose to reinvest, your effective return is immediately reduced by taxes. In contrast with share buybacks, you don't face immediate taxation. The value of the repurchase is reflected in a higher share price and a larger future dividend. Over time, this tax advantage compounds, allowing your returns to grow faster compared to receiving and reinvesting dividends. Even dividend reinvestment plans can't avoid this issue. Taxes reduce how much of your dividend gets reinvested, undermining the compounding effect. Growth stocks and buybacks, on the other hand, let the full amount be invested, compounding at a higher rate over the long term. Dividends might feel like a reward, but they don't actually make you wealthier. When a company pays its dividend, it essentially reduces its cash reserves, which directly impacts its valuation. Let's take the same example we had before. If a company pays out $1 million in dividends, it effectively removes $1 million from the company's value. The money doesn't create new wealth, it simply shifts from the company's balance sheet to your pocket. In essence, dividend payouts don't create wealth, they just redistribute it. But the problem doesn't stop there. By pulling out cash from the business, the company has less money to reinvest in growth opportunities. This slows down their ability to expand, innovate, and remain competitive, ultimately limiting your long-term returns. Growth stocks take a different approach. Instead of payouts, they reinvest their profits to expand operations, develop new products, and strengthen their market position. This strategy rewards patient investors in two key ways. First of all, the company's growth drives higher stock prices, compounding your wealth over time. Secondly, you control when to sell the shares, giving you the flexibility to optimize tax timing and maximize after-tax returns. While dividends offer the appeal of immediate payouts, growth stocks allow the company to do the heavy lifting, growing faster and creating compounding opportunities that dividends simply can't match. By now, you might think that I hate dividends, but that is not the case. I just believe that they should be issued at the right time. Dividends make sense when a company has matured and lacks meaningful growth opportunities. For instance, a utility company with steady cash flow and limited expansion potential might use dividends to return value to shareholders. However, dividends should only be paid when the company isn't undervalued and when share buybacks wouldn't provide a better return for investors. Paying dividends in these situations ensures that cash is distributed responsibly. Dividends can also benefit investors seeking reliable income, such as retirees, but they should never come at the cost of the company's financial stability or its long-term growth potential. In short, dividends are appropriate when growth prospects are limited, the stock isn't undervalued, and the payout is sustainable. But even then, share buybacks may often create more value. What do you think about my thoughts about dividend investing? Do you agree with the issues that I see in them? Leave your thoughts in the comment section down below. If you enjoyed the video, consider subscribing and pushing the like button. And as always, guys, I hope to see you in the next one. Bye.